Let's not waste any time. Let's get right to it. Market Mondays, the game inside of the game. Disclaimer, do not remix, copy, reproduce my material without written permission to do so, or legal action will be taken. Join the stock club. If you want the greatest stocks on the planet, as well as the greatest entries, join the stock club. Please put yes in chat if I've made you money from stock club. So for those who are unfamiliar with me, can see that I have provided value for you and help you. So you get the 4 best stocks for retirement, the best places to get in and out of the market, the best growth stocks to invest in, the 2 best places where to get into the market, additional entries from the algorithm Athena, 28 additional bonus picks on the year, a 10-minute call from 9 p.m. Central, Monday through Friday, and the amazing stock club call that we have every single week after the show. August 1st through 3rd, we will have a stock club flash sale. So for those of you that join the flash sale, you will not get the trading room component added, but for those of you that join tonight, or if anytime you join at full price, you will be able to get that added as well. For those of you that want to join the crypto club, you can click the link in my bio, or you can join here. You get the 5 safest cryptocurrencies to invest in, the 3 best prices of where to invest every month given by myself and the Dream Team. Shout out to the Dream Team. 3 bonuses given every month, additional entries from the algorithm Athena, 3 surprise bonus picks on the year, private Telegram channel to receive gem of the week from me and the Dream Team, and that will come out on Friday. And for those of you, when the market was at 50-something thousand, when I told you guys we dropped down to 29 and 28,000 and some change, that is an indication of the kind of prices you will be able to get, because we'll be able to tell you when some of these things are going to drop before most people don't know about it. And we'll be announcing the Dream Team private trading bootcamp coming soon. Trading After Dark will resume in September, and the stock club call is tonight at 9 p.m. Central. Shout out to the Red Panda squad and everyone in the stock club. Jerry, I'll see you on tonight. I appreciate you so much, but we'll have an amazing time there. Subscribe to my YouTube and join redpanda.com for exclusive information and updates there. And once again, college athletes, I want to sponsor you this season. So if you are interested in being sponsored by Red Panda, send me an email to ian@joinredpanda.com. And Stock Market Secrets Part 3 will be released tomorrow exclusively on TikTok. So here's my favorite tool to be able to search for stocks by sector in less than 30 seconds. Please write the site down, fknol.com, and let me show it to you. So let's say you're on a site and you want to look for, like last year or even this year, momentum stocks. You can click here and it will easily list all momentum stocks. And the part that sucks about investing is that 80% of your time is digging through things that will give you an edge or potentially make you better. But look at this. You have a list of leveraged bonds, list of 5G ETFs, aerospace defense, aerospace ETFs, Africa, right? So we can look through here and scroll and print these out or put these in an Excel sheet for those of you that like Excel. And you can have a list of potential momentum stocks that are available. The site is fknol.com. Or let's say you wanted to go through the dogs of the Dow, which I'll go through later in full. But you can look at Chevron, WBA, Cisco. That's an example of some of the things that you can do. Or if you wanted to scroll down further, and let's say if you wanted to look at alternatives by hedge fund and private equity, you can then get a list of potential companies. So you see Blackstone, which you talked about last week, as well as BlackRock, KKR, Carlyle Group, IAC, Ares Capital. You can then begin to segment what type of companies or what kind of sectors you would like to be involved in. So let's say you wanted to have some socially responsible companies. This tool easily segments them for you, and then you can have a list. So right here, this is a list of 25. Put 25 in chat for me. A list of 25 potential responsible ETFs that you can invest in. And then if you click here, you can then see the remaining 26 through 47. Or let's say if you wanted large mega cap, you can go here. If you want bond ETFs, you can go there. Iron, Italy, right? That's the great part about this site, is that you can dig in and make up. So Kudos to my guy in Stock Club. If we wanted to look at natural gas ETFs, it would give us the 5 best ones that are currently available. And let's say if we even wanted to look at like dividend yield ETFs. If we want a dividend ETFs, we can click right here and it will give us a list of them here that we can be able to look through. So that way, even gaming, list of gaming ETFs. So this way you never have to depend on anyone or even me to know where to invest. So these Activision Blizzard, already told you, great. Electronic Arts, amazing. Take-Two Interactive, great. YY, okay. Zynga has been doing great this year. So now you have a list of companies that you could potentially invest in, and you never need anyone else. I have no financial ties to this company. I just thought it was a great damn resource, and I wanted to share with you guys. FKNOL.com. Put fire in chat if you thought this was a great resource for you. So I got tagged in this article. A Japanese billionaire invests half of his $100 billion fund into technology stocks, right? And I know you guys have heard me beat this drum forever, but let's break this down. So 60% of the fund is in 2 holdings. So 2 of the top holdings of SB Management accounts for more than 60% of the entire investment portfolio. Now, this son has a net worth of $45 billion. He's in the top richest 30 people in the world. He was 29th on the billionaire list across the world, right? So, and he's also one of the richest men in Japan. And so I tell you, you don't have to listen to me, and thank you, Steven, for tagging me in this. You don't have to listen to me, but look at what the top 1% of the 1% are doing, and also what the top hedge funds are doing. So let's look at, and then at the end of the first quarter, doing this, SoftBank reported $17 billion. Absolutely amazing. The largest ever quarterly profit by the Japanese firm. So coming off a recession, coming off the pandemic, they invested heavily into tech, and now you can see what the multiples are now presenting. This is a key lesson. Put this in chat. You want hyper focus on a few excellent companies. I'll say it again. You want hyper focus on a few excellent companies. You don't need 26. You don't need 34. You don't need 50 stocks, right? Unless you have some great competitive edge that other people don't have. You want hyper focus on a few excellent companies in your portfolio. Let's look at some of the things he invested in. And I saw people even, and kudos to Stock Sharks, I was seeing people say, well, most funds only want 10 to 20% return. Not true. Put yes in chat if some of the stocks that I recommended have got you over 12% return in a year, and then put the percentages in chat. Do you think these fund managers that are managing billions of dollars just want 10% return? They want minimum drawdown, but maximum upside. Please put this in chat. Minimum drawdown, which means minimum loss, but you want the most gain possible. Amazon, Facebook, PayPal, Microsoft, not a bad 4. Google, Salesforce, Netflix, TSM. Great list. You can make the argument NVIDIA over TSM. Shout out to my guy Clint. Clint was asking, hey, what do you think about NVIDIA when it splits? It's going to do well. We have seen historically what splits can do for a great company. And then also, homework, please write this down. Homework assignment number 1. Go look at the top 25 companies that have split, and then see what the average growth of them over a 5-year period tends to be, so you can understand what the growth could be going forward. Last week, I shared for the first time ever that one of my hidden secrets is to look at Vanguard and BlackRock and see if they own the stock that I'm looking to invest in as a hedge. And me being a minnow and they are whales, I want to follow what the whales are doing, right? So it's a market maker strategy that I am using to ensure safety. Now, to go into that, do a fund by fund analysis, and you want to look at the top 10 ETFs to see what they're invested in. And I could make the argument, if they are not currently invested in, you should probably hold off unless another market maker is in that stock heavily. For me, I'm going to write this down. For me, I need to see the stocks that I'm looking in to be in 7 out of 10 ETFs. Please put 7 out of 10 in chat. That way I'm able to have safety. And even if they reallocate, that's fine. But if I see that a stock that I'm picking between those two entities with that much money under management, if they are only having that stock in one or two funds, is usually a sign that it is not that good. Peter Lynch has an amazing quote that pretty much sums up everything that you need to know about investing in one simple quote. Absent a lot of surprises, stocks are relatively predictable over a 20-year period. As to whether they're going to be higher or lower in 2 or 3 years, you might as well flip a coin to decide. And the truth is, the longer that you hold an investment, the higher the return will be for you and a higher the margin of safety. Drawdown over a 1 to, let's say, 3 week period for most stocks, extremely high from our long-term investors that are seasoned. Would you agree with this or not? Now, over a 6 to 12 month period, it smooths out a hell of a lot. Once you get 3 years in, 4 years into a stock, if your stock has not went up from the cost in which you bought it, unless it was a high, and with quality stocks, even if you buy them at tops or highs, within a 2-year period, they should have made new highs by then. This quote tells you everything that you need to know. Please put in chat, I will have the discipline to hold great companies for 20 years. Stop looking for flip. And that's why when you guys ask for plays, I'm like, you're playing with your life looking for plays. Look to hold for a long term. Let's look at how to use the Buffett indicator really quick. And this is a long-term valuation metric. So if you look from 1970 to right now, you can see that market to GDP is a long-term valuation indicator for stocks. Become super popular as of recent, and you can see the levels in which we've hit. So now we are at one of the highest values that we've been for the Wilshire Fire in comparison to GDP. And this is what the algorithm, how it's designed in order to be able to get this measurement, right? So normally, and of course, 2000 was different. 2007 is different. And I think we were pushing up for a lot of different reasons. We didn't have the kind of quantitative easing now that we did. In 2000, quantitative easing was not as high as it is now. That's one of the reasons. Money is very cheap. Loans are very easy to come by. But what you want to read, you want to hit the all so you can see the entire data set and then see what those tops are. So people are saying because this high was broken, we should break down. Write this down. Normally we have 3 hard pushes on this indicator before we have a pullback. Later tonight, I'm going to reveal for the first time ever one of the cycles that I actually use to be able to predict a market crash pretty reliably. Now, when this indicator is this high, I'm not looking to add on more shares at an aggressive rate unless it's in the ideal spot. I still think you should buy every month if you're doing dollar cost averaging. If you're looking to get in at exact prices, you should then load the boat, proverbially at that price when you're ready. But when we are this extended, this is the same as a top. And that's why I tell every investing trader, like if you can read one chart, you can read them all. You do not want to then overextend and make your first investments when we are super overextended. And the long-term 20-year macro period, and even for those people that invested in 2000, same thing. Over a 5 or 6 year period, you should be fine. But from 2000, we slid down. 2009 was the bottom. Great. And it will continue to rise. If it ever gets to almost this 50% value line, or let's say 35%, and it dips below there, you then want to buy very heavy. So you can see what the mean average is here, which just means the middle of where we should be. If we ever drop below that mean line, that is a place where you want to look to load the boat. And over a 5-year period, you want to hold for a long period of time. Somebody asked me an amazing question of what should we do if we hit a decade or a flat decade or a dead decade and the market isn't really moving. So the best time to prepare for what to do is when that situation is not here. The market is rising. Apple hit an all-time high this morning. Great. You have to prepare for disaster when everything is going right. So let's say we have a 10-year period when the market is just flat. This is when you would build your base. You still would want to buy every month because what normally happens, and you'll see this when you do your homework, and I'm gonna give you an assignment to be able to find out, but every single month you want to accumulate a certain amount of shares, or year end, you need to have a certain amount of shares that you want to have under your portfolio. This is what happens, however. Markets that hit a high, people will want to buy then. But when the market is flat, and because remember a couple months ago, everyone was like, oh my God, Apple is moving so slow. Ian, give me something else. And I'm like, you get a chance to build a base here. That was when it was in the 120s. Now it's in the 140s, and everyone's like, when do you think it's going to come down? It was down a couple months ago. The same principle for that, being patient, because the entire game of making money from long-term investing is being patient, right? If you're able to do that on a monthly basis, you would be able to sit through that for a decade or a 5 or 6 year period, like we had to do with Microsoft when Ballmer was running it. And then when he was no longer CEO, the company took off to the upside. We talked about last week how Ms. Woods built the base around Tesla, and then it took off to the upside, but it was tough to sit through. So please put in chat, what is the annual amount of shares that you're looking to buy? And then if we ever hit a dead or a flat decade, you still want to be invested in the market for the long term, because when things rocket up to the upside, you don't want to say, hey, I wish I would have been invested when this was a lot cheaper. Quiz question. How often does a flat decade occur within a century? If you don't know, I want you to go look at the Dow Jones, go look at the S&P 500, and then go see out of 100 years, how often do we have a flat rate of return for a 10-year period? I thought this graph from Visual Capitalist was amazing about the world's 100 biggest companies. And normally the signs are right in front of you. So if you want to know what companies to invest in, they're usually listed. So of course, Apple has the highest value of 2.1 trillion. But this is one most people don't talk about. This is one. Put in chat if you researched this company before, or if you've never, ever heard of it. 1.9 trillion value. Then Microsoft, right? Amazon at number 4, Alphabet, Google is at number 5, Facebook is at number 6. You can go to visualcapitalist.com and see. But when you're looking internationally, so for those of you that are like, hey, which companies should I invest in? You should look at the ones that have the highest value and then look at the prices that best serve you to be able to get in. But you can see Walmart, Nike, Netflix, Disney, United Health, MasterCard, Visa, PayPal. So these are the service providers. And then we can see banking all in this bubble. And you can see certain industries dwarf others. Nvidia is over here at $331 billion worth of value, right? T-Mobile is a little bit smaller. So when you're making a comparison, you can look at a chart like this and then say, hey, these are the ones that would be best served for me to be in. And then UK, Unilever, AstraZeneca. Great. Those are 2 you can potentially invest in. Ireland, Medtronic, Accenture. So if you want international exposure, you are best looking at the companies that are the biggest in the space to have safety. But you can check this slide out in full at visualcapitalist.com. And there's always this wonder or quote of, can people beat the market? So when I came up with my formula for how to beat the market, the primary thought was, I think the best way to beat the market is by anchoring myself to it. So if the 2 indexes, if I tie myself to S&P 500 and NASDAQ, or Dow and Russell, those will be the anchor. So if we have extreme drawdowns and we go down 50%, what people try and do is pick stocks that will outperform those on the way up. I was like, why not use, if we have pretty much a guaranteed return of 7 to 12% for an average investor. For an exceptional investor, you can probably get more. Investing has considerable risks. Please consult your advisor. It does not mean that you're able to, because I am able to. But the core of beating the market, in my opinion, in my thesis for what I've developed, is being tied to the market first. That has to be your base. Your second level then has to be an asset class which pairs with that and can go a little bit faster. And that's where the 2 technology companies come. And like I said, I love the gentleman. I really do. But once you hone in on that system, you should be able to get some solid returns from good companies that people have heard of. So like Moderna is up 271.8% in 1 year since I caught it. Kudos to the stock club members that got in on it. Shopify is up 260% since I told people about it in stock club April 8th of 2020. TECL I do not recommend this to you to buy at a higher price during extreme lows or a recession or an aggressive pullback. If you have the capital and you can withstand the drawdown, it may be a place that you can enter. But TECL is up 347.6% since I called it April 8, 2020 for Stock Club. Yes, it is possible to outperform the S&P 500, but the truth is most people do not want the workload that comes with that. But my core philosophy is the way to beat the market is to have your base tied to the market itself. 2Tech, 2Index is designed to beat the market by investing in the market and letting the exposure do the rest for you. And even when you draw down, if tech bleeds down 75% when the market is going down 50, the drawdowns are going to be a lot slower as well, investing into the S&P 500. Here are the top 15 holdings of the Russell 2000, which is a growth sector in my opinion. And let's look at some of the stocks in that top 15. All right, first up we have AMC on the Russell 2000. You can see it is above this 200-day moving average. Amazing. If it ever drops back down to like 1283, that'd be a solid place to get in. You don't want to chase. Solid company, solid return, great. You don't want to chase at bad prices. Look to hold for the long term if you're going to be in it, et cetera, et cetera. Let's go to plug. Let's go to the next one, PLUG. You can see the same thing. You don't want to chase. Please put in chat, don't chase based on. So the 200 is down here at 525. The yearly open was at 34.64, right? So you don't want to chase. Anybody who got in the 70s are screaming right now. Please put this in chat. It is all about the price in which you are able to enter. Because you could have a great momentum movement based stock like this. But if you waited 6 or 7 months to get into it and then you finally got in at 57, it was not the ideal time to get into that stock. Get in at prices that will put you at a advantage that most people will not. And talk about FOMO. If there's one stock I wish I would have called last year, it would have been Novavax. If you look here in March, it was at $9.01. 200-day was at 93.53. It ran up to 331 and it almost dropped back down to this yearly open at, what is this price? 112.92. It was there for a brief moment. I didn't have my alert set, so that's a great lesson for you. So you don't make the same mistake. Set your alert if there's a price on which you want to get in, and then you can see it went from 112 to 331. It came back down, almost touched it again. It's at 188. So, and this is why when you go back and study history, you can see going back to 1995, Novavax historically has done these kind of big booms and busts, right? So back in 96, it got to 166.62 and then fell apart. In 2000, 248 was a high and it came down to $89.55. But look at these historical moments. In 2000, it got to a high of 311 and then it fell all the way down to $33.37. And then it had a couple small mountain tops here. But the next time this happened was in 2015. I remember this move went to 300. And then before 2016 came in, it fell to $22.43. The homework that I want you to do on Novavax is once it falls 80% or 70%, how long does it take to go back up? So we had a big boom in 2000. We then had another one in 2015 and then again in 2021. Please take advantage. And then for those of you that love support and resistance, you can kind of see the areas. 171.59 is a secondary resistance area. So in 2002, 2005, 2009, it hit those levels over and over again and then fell apart, followed by the big mountain moves up to 300. And you can see here, if we look at this level here at 282.96, it normally does not sustain that price. Once it gets in that area or that zone, it starts to fall apart. Next week, I'm going to do a full breakdown on what I call buy and sell boxes, but this is an example. So I will go across this entire screen and I will mark off this area, double click it. I would change this color to red. And then I would know as soon as I look at the chart what that looks like. Pink. Let me make it red. Okay, great. Make it red. And I know as soon as it goes up to these levels, it does not sustain these wicks or these thin lines right here. That is an indication that the price went there, but because it's thin, the prices were not able to be sustained long term. So you can see anytime we got into this red zone, they were not able to hold their price. Does that make sense? Yes or no? And then also there are buy areas or buy zones that you should mark off, but I'll go over that full. Speeding through the Russell, this is the notorious GME. We've talked about this one enough. Let's go to RH. Great. We've seen this one break up to the upside tremendously. Once again, yearly open, 448. And yes, the price is high, but you want to pay for quality. 448.44 was a great entry for it. The low of that was 412 and it went to 713. If you're not using the yearly open, you please, I'm begging you to put it on your chart. Let's look at PAN, something Troy's talked about. In addition to DraftKings, we can look at that. You can see that they had a nice movement up. They are then starting to break down. If it gets down to this 200-day moving average at 2501, could be a great place to enter. Secondary entry could be at the 8526 area for those of you that are not using the 72 or the 100. Rounding out this list is NTLA, Intella Therapeutics, had a hell of a push up. Let's look at Sunrun. And then you also want to go back since inception to see if the stock is good. So let's look at CLF, and this is the reason why you want to go back since inception. So the 5-year chart looks pretty smooth, right? The previous top of it was what, 2017, $12.22, went down to 263. Great. It's at 23 bucks now. But when you go back and zoom since the very beginning, this is what you'll see. In your opinion, does this look like a good stock? Previous high was 121.95, fell all the way down about a year and a half later to $11.81. Everyone say that they can live through a drawdown like this, but most can't. Great. All my technicians, you can kind of see it broke down again, came down to 31, 32 bucks, and it's just barely crossing above the 200-day moving average. Now, it is to the upside, but when a stock historically falls like this, the probability of it going from here, say 1489, to getting back to this mountaintop of 102 is very low. This is why you need to go look at since inception to see if the stock is truly remarkable. DAR, on the other hand, tells another story. Top and fell down and that's why I say building the base is good. And it hit this 200, fell apart, and it's been on a tremendous run since 2020. You can see here at around 14 bucks would have been a great entry, and now it is currently at $67.54. When you look at this long-term chart and fully zoom out to see the macro picture, it does a tremendous service to you to be able to know what it's doing. Same thing with Decker's Outdoor. Great momentum, but they've been able to sustain it. They are going up to the upside. Let's look at LAD. Some of you asked about this in comparison to Tesla. I don't like it better than Tesla, of course, but LAD, Lithium Motors, is moving pretty damn strong. And this one is APPN. Once you get further down the list, I don't like them as much. The top 5 or 6 are usually the best in an index, and this is true here. APPN is solid. Most people don't even know what the company actually does, but there are some better examples. Like if we go back to the deck chart, we can see I like this chart a hell of a lot more than APPN. Can you agree? Yes or no? So you want to invest in companies that, of course, their stock is rising, revenue is great, profit margins are great, and then you want to choose safety. And I saw Rashad post this the other day, and a lot of you hit me like, man, Biden's about to crack down on tech. So he's going to sign an order to crack down on big tech, boost competition across the board. And I think it sounds good, but hypothetically, in the grand scheme of things, I don't think it will affect Apple, Microsoft, Google, AMD, Nvidia, etc. And I understand this may be jarring if you're invested in tech, but historically, these kind of measures really don't move the market as much as they used to back in the early 2000s or prior to that. So in the words of the great philosopher, Rocky Maivia, it doesn't matter. That those kind of legislative practices are not going to have a tremendous effect on a top 10 tech companies. But I have 24, 25 reasons, but this is just one towards the end of the totem pole. Let's look at some of Joe Biden's donors. So we have Donald here from Palumbo Partners. He donated $9 million. We have James, who donated quite a bit of money. And then we have Michael from Sequoia Capital. Please put in chat if you know what Sequoia does. He donated $3.5 million. These are some of the companies that Sequoia has funded. Apple, 3Com, Airbnb, Cisco, DoorDash, Clever, Dropbox, Evernote, Eventbrite, Gamefly, Green Dot, Inside.com. Kudos to Jason Calacanis. Instagram, Instacart, PayPal, Pilot, Ring Central, and Robinhood. Some of you have been asking me what I think about Robinhood. We'll touch on it later. Could be a game changer, right? My point is, if that much money was donated to the campaign, do you really think there would be a hard tech crackdown when consumers aren't even complaining about tech monopolies in the same fashion in which they were in the early 2000s? What are you going to replace them with? So let's say if it does happen, right? Hypothetically. So if Instagram goes public, say Messenger goes public from Facebook, Apple Music, and let's say the App Store goes public. And I can make the argument, the artists that you love and the companies that you love, like Uber, Drake, DoorDash, Spotify, Instacart, Bumble, Tinder, none of those would exist without the Apple ecosystem. And they get paid a hefty percentage from all those companies to be on the platform. What do you think those would be worth? So with spinning off some of these companies or assets and making them publicly traded, will it be beneficial for the tech ecosystem, or will it make it a bigger beast? Sometime when you slay a dragon, it shows up with 5 more heads. This is the proverbial case for that. Amazon all time is up 214,000% all time. I know people love to make you feel like long-term investing is not sexy. But when people start to tell you that, and hey, here's the play. Long-term, how many people have gotten 214,890% return? Say it with me. Long-term investing is the wave. Say it with me. Long-term investing is the wave. One more time. Say it with me. Long-term investing is the wave. A lot of you are getting knocked out of your position to be able to take care of your family. And there's even arguments on even if you should look to build generational wealth, because in 3 generations, it typically goes away. Nevertheless, let's say by generation 2, if the kids do mess it up, you can put it in the will. If there are certain entities that you want your money to go to or causes, at least you can do that. But the quick flipping leads to a lot of danger. I want you to hold stocks for at least 1 generation if you truly want generational wealth. Let's go through the top 30 stocks in the Dow, and I'll tell you which ones are good or bad, so you guys can never say I didn't tell you which ones were excellent and which ones were terrible. So Disney, absolutely amazing. One of the companies that I loved last year for sure. Absolutely amazing. Walmart, incredible. It's going to take a little bit of time to go back up, but Walmart is amazing. WBA, I don't like that much. Visa, love, 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 love. Verizon, I'm not big on telecom, so I don't like that one as much. United Healthcare, absolutely incredible. TRV, solid. Don't love them to be in a portfolio, but they're very good. CRM, very damn good. Moves a little bit slower than most tech, but the company is amazing. Procter & Gamble, good. May take 18 to 24 months to go back up in comparison to some of their competitors, but a very, very, very good company. We talked about Nike before, but I want to tell you, yes, Nike is amazing. Currently at 161.82, all-time high 162.43. Do you think they'll break that high in the next 3 or 4 months? I say yes. You already know how I feel about my baby Microsoft. Absolutely amazing. Let's look at Merck. Don't like as much. JP Morgan, led by the legendary Jamie Dimon. Yes, love. Johnson & Johnson, love. IBM, not so much. Intel, not so much. I think there are better competitors there If I had to pick between the two, Honeywell, one I haven't talked about a lot, but yes, look at the entry, 212.84. If you're using the yearly open as a second or third, maybe fourth way to get into the market, solid. Home Depot. Everyone in construction absolutely should be investing in Home Depot if you have the money to do so. Goldman Sachs. Absolutely, yes. Look at this. Entry, potentially 267 from the yearly open. Don't say I don't give you the game. I'm yearly open, 267, currently at 380. I know people are talking about Goldman lost some of his luster. Yes, BlackRock competitively is edging some things out, but Goldman is still a powerhouse. Always has been, always will be. Let's look at Dow. Don't like it as much. Dow Chemical. Let's look at Coca-Cola. Solid company. It's a little bit of a slower mover, but it's a good company overall. Let's look at Cisco. Yes, like this one a lot. Chevron. Energy has had a hell of a rebound this year. Like it. Let's go to Caterpillar. Absolute love. Incredible company. Let's look at Boeing. Called that one last year as well. And I told you guys the prices in which to get out of it, it hit that price. For those of you who got out, job well done. You guys already know how I feel about Apple. Absolutely. Yes. Amgen. Okay. But it is a safe investment in aggregate. And let's look at this real quick. This is why I always tell you to zoom out. So when some of you like, hey man, I don't know if a stock could go up over 30 years. If we go back to 1990 and then let's say skip to 2000, growth, right? 2000 to 2010, a little bit flat. And that's what we talked about, building up that base. But look what happened from 2010 to 2020. Let's say your average price was $51. 2020 end of year, it went up to 231, got to a high 276. That is making money in your sleep for investing in great companies. This is why I tell you guys to hold for a long period of time. Let's look at American Express. Hell yes. I like Visa way more. Visa is a better company, but American Express is taking off to the upside. Great company, great investment. Same thing about building the base. It's about knowing when to get in, right? And then let's go to 3M to round this out. Don't like 3M as much, but American Express, absolutely amazing. And oftentimes we feel like we don't have enough money to invest into the market, and you guys can go Google this story, but Mr. Earl only makes $12 an hour. I think he never made more than $25,000 a year. And ended up with a net worth of $500,000 from investing in the market. Now, let's be real. If you're an adult over, let's say 33 years old, and you make more than $12 an hour, you do not have an excuse for why you cannot do this. The most important thing is to consistently invest. The only reason why most people don't have enough money to retire is because they are not consistently investing in the market. I don't make any money if you go to Vanguard or BlackRock or Fidelity. But it's going to be the thing that causes you the most amount of stress. And you know, like I know, when the money isn't there, it's always there in the back of your mind. Be mindful. You are buying clothes and shoes and accessories, and that, like I said, is a mechanism to get money from your pocket into the businesses and families of others. You have to then invest in yourself first. Please put invest in yourself first in chat. But if this brother can only make $12 an hour and did not have all the information and this kind of information from me and others and all these books to be able to know what to do, there's no excuse going forward why you won't be able to generate the same kind of results or better, even if you don't make a lot. Next week, I will make the case for why Doge is dead, and hopefully I can get a brother on who's doing pretty well in Doge. But the thing that I want to stress to you guys is to take, because even when the clip got posted, people were like, oh, you don't know. And I'm like, I love that. I love when you say I don't know, because I do my damnedest. And for those of you who know me, everything I say is very strategic and intentional. But when we are continuously hovering in a price range from 23 cents and it touched 18 and there is no upward movement yet. And it's not just because all of crypto is down, right? And if Doge was such a dominant force, then why would the case for baby Doge and the spinoffs? But we'll talk about that full and next week. And I want to give you some tools to help you understand what are good areas to get in. And I'll tell you, if it gets to 8 cents, if you're willing to hold it for a 5 or 6 year period, you have a good chance of then being profitable in it. But we'll cover that next week. but 2 tech and 2 index. I want to stress that again. And I want you to choose safety over sensationalism. Sometimes when you guys are trying to get these big ass gains, you're going to destroy your account and you're going to destroy your peace of mind. Put in chat, choose safety over sensationalism. And for those of you, if you are able to get 20, 25, 35% gain, you wouldn't believe the amount of money that you're then able to reallocate from your primary businesses or when you get raises. A lot of times mistakes are made and you drew down or lost 60%, and now you're looking for something to grow money really fast because of the prior mistakes that have been made. I totally get it. I've been there too. But it's a never ending cycle of choosing hype over quality. Let's look at Amazon real quick. 50%, of course, in Q3 of 2020. And these metrics are pretty much the same, but the online stores drives half of their revenue. 21% comes from third-party sellers. The physical stores are only 4%. Subscription services are only 7%. And Amazon Web is going to be great. I think that presence in the online stores, I think that percentage will grow with the new CEO being in place. And I think Amazon Web Services will expand even more because there's more that they can do in that B2B community to grow that market share even more. Once again, here are some of the safest stocks to invest in: Google, Nvidia, Shopify, Twilio, ILMN, and then Intuitive Surgical. So write these down: Google, Nvidia, Shopify, Twilio, ILMN, and ISRG. Once again, here are the dividend stocks that I like. Apple, even though it pays a small one, is there. Lowe's, Costco, McDonald's, Nike, Visa, Starbucks. Starbucks pays a small one as well, but for the growth that you get, you can get a dividend in a quality company. I don't want you to chase low quality companies that pay a higher dividend because they often end up cutting those down if the market is not going. So a prime example of that is AT&T. People are like, well, the dividend is great. Okay, great. The high, once again, was in 1999, $59.88, which for telecom isn't bad, but overall, $59 is not the highest target that a quality quote unquote company should have. Bonawyn said before, like AT&T almost specializes in buying assets at the highest prices and then selling them at a dramatic discount. And then if we zoom into this year, we can see the yearly open, $29.39. We had a huge drop, but this pattern of them dropping over time has been there. I don't even know many people with AT&T cellular service. So because the dividend is great, that's the only way they can attract most people to invest in it. But then if that dividend gets cut, then what value does it have? You can invest in quality companies, get a dividend, and get the growth plus that quarterly payout. Yep. And I'm going to keep beating this drum about all-time returns. Starbucks, all-time return, 34,450%. Put in chat, I will invest for the long term to get these gains. Okay. So if you think that was a fluke. Cisco, now the sexiest company of all, 67,000% return all time. And it had a point where it drew down a lot. But this is what happens when you invest for the long term and you're not choosing sensationalism. So remember what I said about Pelosi last week in her track record and her husband. So Pelosi just put a lot of money into Google. She also got some calls in Apple. She invested in Amazon, invested in Apple. So if you use the site that I talked about last week, you can then see what some people are investing in the political realm that you can take advantage of. For those of you who didn't see the episode, please go replay it. Or for those of you in chat, you can put the site in the comments if you like. These are the top 10 stocks to stay away from. I want you to be careful. So IVR, Macy's, Apron, Occidental Petroleum, Groupon, Harley Davidson. But let's go look at 3 in particular. Let's go look at IVR, PK, and DB. So there's a lot of talk about housing. So this is Invesco's mortgage capital, right? So we can see the high was at 24. That was back in 2009. This is, and in 2020, it went to 182. It is at $3.50. Just looking at this chart, is this chart going up or down? Now, it's had some solid movement from 340 to 448. Great. Nothing to write home about. And if you think the mortgage market is going to be big in 2008 and 9, I think you're crazy, to be honest, because people are putting down cash and paying overvalue for homes now. It's a different environment in which we're in. Stay away from this one. I know it got pretty popular, but stay away from it. Parks, Hotels, and Resorts, Inc. Not a horrible company, but once again, the previous high was not within a year. You can see this happen in 2017, $34. It fell down to $3.99. Now, if you want to swing trade it, great. And you want to get $10 off of it as a trade, okay, maybe. But as a long-term investment, does this chart look to be going up or down? It is to the downside. And also, this is the 200-day moving average. It is to the downside. Stocks that are historically underneath the 200 on a higher time frame are not good companies to invest in. And let's go to DB, Deutsche Bank. You tell me. Some of you hit me, and I don't know where you got it from, if you got it out of the Discord or whatever group. But Deutsche Bank's high was at 159.76. What advantage does Deutsche Bank have over JP Morgan, Goldman Sachs, in the finance space, BlackRock, PayPal, Square? Almost none. This is not a good one. And if you want to compare it to a good company like Square, you can see to the upside what a good chart will look like. And I saw this on Ben's show with Mike, Animal Spirits. And this is a remarkable stat. 47% of Robinhood users use the product daily. Now, you have to give a lot of credit to the design team and those who built out the wireframing for the UI and the UX. That has a lot to do with it, right? And the stickiness of it. But this is a hell of a stat, because I know most people that probably use other platforms that are competitors are not on that much. There's a lot to be said about Robinhood. I think the ticker of HOD is hilarious, by the way, but they are in an interesting place. And Ben made the case where they could end up being like the Facebook or of this generation for investing. I don't like brokers per se to invest in long term, but depending on what the price is and how it acts over the next, 120 days after it IPOs, it could be interesting. But this stat around usage, I thought was incredibly fascinating. Please put in chat if you are excited for Robinhood's IPO. Now get your pens ready. I've never talked about this before. A couple of you have asked me to go over it, right? And I'm not going to do a full hour breakdown because it'll take me an hour and a half to really explain it. But the Benner cycle is really a market predictor. So for those of you that may be doctors or nurses, you've heard this talked about in your field of study. But the Benner cycle, and this is not the crystal ball, but I do use it in association with to understand larger market cycles. So it came out in 1967, and it's one of the few studies that have been accurate after it went public. So Benner stated that there are tops every 8, 9, 10 years starting around 1902, and then the cycle keeps repeating itself. So when people tell you, hey, you can't time the market, you don't know when a crash is going to happen, you don't know when the market is going to pull back, you don't know when the market is going to be soft or flat, that's not true. I'm never going to say this again outside of Dream Team and outside of Stock Club. Every book that you can find on Benner cycles, go get it. I'll never say it again. I'll never say it again. So let's look at this. And this is for the Dow Jones. This, and ignore the middle lines, but look at the tops. So in 1902, 1910, 1919, 1929, predicted crashes, 37, 46, 56. Let's scroll to more recent times. 1991. What happened in 1991? Please put in chat for those of us that are older and how it affected the stock market. 2000, 2010, 2018. At the bottom, you can also see when the bottoms are, which are ideal times, or what I define catastrophic times to buy in the market. So 1933, 1949. 1967. My brother was born in 1987. Go follow my brother's channel, please. Big ass kid, BIGG with two G's. In 1987. What happened in 1987? Please put that in the chat. 2003. So it was a little bit off, but there was a soft pullback. And then in 2021, it was predicted for the Dow to then have a downward cycle. It ended up happening in 2020. But this is something that was printed in 67. Just like there are certain innovations and that Tesla was able to uncover that he is talking about now, or excuse me, that are in existence now. There is a rhyme and reason to the market. You should stay away from these middle areas. But if you do look at them, there will be times when the market could be flat for a while or could be a softer market. Let's look at this. So if you look at the bottoms and you compare it to the Shiller index, you can see here, this is for another index. You can see the times when we were going to bottom out: 78, 85, 96, 2005. So that was right before the recession. 2012, predicted for something to happen in 23. What could potentially happen in 2023 that could make the market potentially soft or drop? And then the tops of the market: 1927, 1945, 1965, 1981, 1999, right? 2019. So when people are telling you there's no way to know it, I'm like, that is not true. The truth is most people are not reading how to get the information to know if a stock is really undervalued or oversold, or if we are in a bubble. The middle lines, you can see these means: 2007, 26 would be a mean area, 1980, 1989. When you go study these cycles, you will then know when bottoms and tops can occur. It's called the Benner cycle. Let's look at one last one. 87, 2003, 2021. So some were saying 2019, some were saying 21, some were saying 23. That is a zone in which you need to prepare. Tops 2018, 27. And if we bottom out in 23, we may have a 4-year period. Great. And then we may see some exuberance in 2027 as we did in 2007. And then maybe a flat or softer market around 2029. Trust me, when people are planning for 30, 40, 50, 60 years, they're not just looking at a short-term horizon. So when some of you are like, hey, this tech boom won't last for a long time, I'm like, you ain't been investing in 2 years to deserve the right to say that shit. How? Do as you please. But technology is not going anywhere. And then, this is a great quote. When he compared them and saw up and down yearly cycles repeated in a fixed sequence of a larger cycle of 18, 20, 16 years, and a small cycle of 9, 10, 8 years. These cycles depicted reactions and depressions. According to Benner, this was no chart with no charting. So there was no Robin Hood. He couldn't listen to us. He couldn't listen to Kramer. This is before all this technology existed. And this is why I give people like him and Jesse Livermore credit and Paul Tudor Jones credit, because they did it when you had to graph everything out. There was a certain hunger that they had for this information that people don't have today. According to Benner, these were cast iron rules, and he referred to them as God and prices. This also works for farming. It also works for birthing rate. It also helps to understand when an economy or a country will be in a boom cycle and or a bust cycle. But you don't get this damn information arguing. You get it through reading and learning. Mark Cuban came on here and said, read 5 hours a day. And he's a fucking billionaire. Put in the time. Stock Club members, 100 pages per day requirement, or I want you to go through 3 books on Audible. Dream Team, same thing. The more information you take in, that more of an edge you'll have. And here are my top 10 books that I love on investing. Number 1, my Bible, my compass, Money, Master the Game. Number 2, Market Wizards, probably the greatest book on investing and trading I think that's ever been compiled. One Up on Wall Street by Peter Lynch. The 4 Pillars of Investing. Beating the Street by Peter Lynch. Principles by Ray Dalio. And as a bonus, his Debt Crisis book is absolutely phenomenal. The Big Short. Trading in the Zone by Mark Douglas. If you ever have traded, Trading in the Zone, I think, is the greatest book on market psychology ever written. Snipers, Dream Team. If you've read Trading in the Zone and it was phenomenal, please put Mark Douglas in chat. God rest his soul. Against the Gods, The Snowball, which is a book on Warren Buffett, and Poor Charlie's Almanac, which is his partner, and I can argue in some cases is a better investor in some instances than Warren himself. These are the top 5 docs on investing. So number 1, Floored. And I want you guys to watch all of these. Number 2, Trader. that features Paul Tudor Jones in that 1987 Black Monday crash. I want you to go watch that and see what he was doing to then be able to weather the storm. And if you're not familiar, Paul Tudor Jones is the Michael Jordan of futures trading. Number 3, Breaking the Bank. Number 4, The Warning. And number 5, Freakonomics, the movie. If you are serious about investing, you need to go watch all of these. Next week, I'll talk about some of the things I discussed with Fast Company in regards to my concerns about our economy. But let's look at this. This was what the Bush era began, how much debt we were in. Obama, this is where we were. When Trump took over, 20 trillion. Now we are almost $40 trillion in debt. Great caption here. This only becomes a problem if no one wants the dollar anymore. What have I been telling you? Part of this crypto and international investment thesis is a great way to set up checkmate to then get people off of the dollar. But we'll talk about that more next week and how it will greatly affect you. 25 shares per month for 5 years equals 1,500 shares in your possession. I know some of you feel like, man, I don't have enough money to buy 300, 400 shares. Cut me a break. But I think in a company that is a little bit cheaper, that has growth potential, you can potentially do 25. Second scenario, 100 shares per month for 5 years equals 6,000 shares, right? And then for those of you that have more money, 1,000 shares per month for 5 years is 60,000 shares. My question to you is, how many shares are you going to have in order to be able to get the freedom that you want for yourself? So once again, most things don't matter in investing outside of a long-term perspective. A lot of people would trick you into thinking about things other than that. But holding for the long period is what is going to give you the freedom that you really want. So I want to know, what number of shares will you buy every month to get to your freedom goal? Will you do 25 shares a month? Will you do 100? Will you do 1,000? What number are you going to pick that you need to invest in every month to get to where you want to be? Tesla hit this black cross, a death cross that has appeared, and Art was the first person to tell me about the golden cross and black cross. And the grand scheme of things, it doesn't matter, but let me take you to a chart and give you a better setup that I think will help you all. And Stock Club members, I'll put these settings in here for you tomorrow. But let me show you what this actually means with our set. So this teal line is the 72 moving average. Down here is a 200. If you look here, you can see as long as this shorter moving average is above here, we are safe. We're safe. What ended up happening with this setup, you were able to see it before on the, if we go back here, we can start to see it cross here on the 11th of May. When this 72 broke down through the 200, it was a signal that Tesla was going underwater. But this is why I always tell you guys to zoom out and look at the longer horizon to get a better understanding on if a stock is truly going up or down. But when you zoom out to a 1 year weekly chart, you can see Tesla is still, the 72 is above the 200. And if we dance down to this area, 550.43, there's an area in which we can get in. It would have to then break underneath 430.78 to then start to push on the weekly chart to the downside. Now let's look on the month. And if we look on a 2 year month chart, we can see that the 72 is above the 200. So in the short term, it did make a cross. But if you go back and look at the long term perspective, Tesla's fine. There's not a huge breakdown. The stock will be safe. You just have to give it time. And once again, this is the problem with selling too soon. In the 1960s, Warren Buffett spent $4 million to buy a 5% stake in Disney. He sold that stake for a 50% gain. He calls it one of his biggest mistakes because that position today would be worth $8.7 billion. And we've all done it. We've all sold things too early, or there's investments that we didn't get in. That I want to keep stressing, long term will give you freedom that you want for your family. Now, next week, I'll walk you through it, but this is what I want you to pair. The 72 moving average with the 200 with the 400. Now, if the 72 and 200 are above the 400, the stock that you're in for long term is safe, but I'll give you a full breakdown of that next week. What's the easiest way to determine stock prediction prices? Simple. multiply 5 from the high. Multiply 5 from the high of top tier stocks. So if the all-time high of a stock is $100, your target would then be $500. If the stock that you're investing in is 10 and let's say it's new, the multiple on that would be 50. You want to 5x and take that from the high to know where to get out of the market. How do you overcome self-limiting beliefs? I will go over that more next week, but you need to start with a book called As a Man Thinketh and read it every day for 300 days straight, and just read 2 pages a day, and it will help to build the foundation of trust being embedded in yourself. Lastly, I want to walk you through the hidden secrets of investing from an article that I did a few years ago that I think is timeless that you need to know. So I define my style as hyper acceleration or like catastrophic investing. So like last year, those are some of the ideal times. So whether it's on a short-term horizon or long-term, I like to get in on the edges. So write this down. Rule number 1, do not give up more than 1.6% on any trade. I don't care how much you love a company, you don't want to draw down. Now for long-term investing, you have to give it some space. So I'm not recommending that you close out at 1.6% loss. I can do it, you can't. I don't want you to do that. But this is a game of retention. And one of the biggest mistakes that I see people make, they make huge losses and then chase to then get back. This is just free game for you guys so you can apply. Number 2, do not forget rule number 1, do not lose money. Investing is about mitigating risk at all costs. And once you do that, the money's there. How many of you have ever, and we're talking about this today in Dream Team, how many of us have spent money in a club or on clothes or on things to show status when we could have just had the status by investing in great companies? Most people treat their portfolio like cash in Vegas and they're just gambling. And I don't want that to happen to you. The number 1 focus in every single trade, every investment that I make, I'm thinking, what is the potential for this stock or investment or deal to harm me or cause me to lose? I only want to pick the ones that are going to give me safety. Number 3, only take trades that will not lose, especially for my swing traders and day traders. You're not going to have a great setup every day. You can't trade every day. For me, I'm fine if I get 2 to 3 trades a week because I know the ones that I'm going to take, I have a high probability of winning. And I know it's tough to sit to wait for a perfect setup, but it's much better than being down 7, 15, 18, 29, 50%, 60% drawdown. And then if you are looking at it from a competitive landscape, for those of you who may want to go work in the industry and then trade for a firm, the track record that you want to present is one where you don't have many losses. And when capital is given to you, you are known to grow it. Being flat on a day beats being negative any single day of the week. Number 4, you have to get the direction right of the market at all costs. If you cannot pull up any stock, ETF, currency pair, crypto, and you can't tell what the direction is in 30 seconds, you do not know what you're doing. Master that part first. Master that part first. If all the cars on a highway are going north, you want to ride north with the flow of traffic. When you're trying to short a market, and that's when everyone tries to pick tops and say when we're going to fall apart. Normally, we're only going to draw down 50% anyway, but you're missing out on the upside, the big long pause, all that, right? You're missing out on 500%, 700%, 1,000, 2,500, because you're the places in which when you're drawing down the most, and the market is drawing down the most, as shown with Benner cycles, right? You should be looking to buy long-term to hold those assets any damn way. 11-1, snipers, kudos to you. You know this. 11-1, asymmetric reward to risk ratio. I want to risk $1 to make 11. Now, if you're able to do that, how many times will you put money in that machine? And then also, once you get up, let's say 10% in an investment, you want to lock in 2% for safety. So, and I make this analogy, like, let's say you had $500,000 in your house. Locking the door is like your stop loss. But what if you had insurance on that money that you only paid $100 a month for, that even if the money was stolen, you would then be able to recoup your $500,000 that was in your home? That's not a good investment, but I want you guys to get the analogy. So lock in profit to be safe in every single trade that you make. taking huge risks to make small gains. You don't want to do that. Please screenshot this or write this down. In day trading, you want to risk 1 to make 5. In a mini swing trade, you want to risk 1 to make 15. And a longer swing trade, you want to risk $1 to make 34. And in your long-term investments, you want to risk 1 to make 50. This is the matrix. Day trade, I'm saying it once again. You want to risk 1 to make 5. A small swing trade, you want to risk 1 to make 15. And a long swing, stocks or futures, you want to risk 1 to make 34. Long term, you want to risk $1 to then make 50. Stop asking me about plays and flipping. You're going to flip yourself and play yourself to being broke. And some of the hidden secrets, there's no such thing as a bad market, only entries into it. When you guys ask me, hey, well, what you think of the market is good every day. Whether it fell 700 points or went up 700, the market was good. It depends on when you got into it. Number 2, yes, the market is rigged, but it's rigged to stay up for long periods of time, especially with quantitative easing. Number 3, getting the direction right is more important than anything else. A lot of you get destroyed on getting the direction wrong and be like, well, I thought go with the predominant direction and you'll be fine. Number 4, the market can only go from a high to a low or a low to a high. That's it. That's investing 101. That's all you need to know. The market can either go from a low to a high or high to a low. And 5, your performance in the market has everything to do with your preparation and what's floating around in your head in the market. That is it. Please write this down. Stop buying in the middle. You want to buy at the edges. One of the biggest mistakes people make is they want to buy in the middle, especially in their trades. You want to buy when things are at extreme lows if they are an incredible company, and you want to refrain from buying when it's at its all-time high. And my last rule for traders especially, never trade without a stop loss. I know people like to have naked positions, and there are some advantages to doing so, but in the event of a flash crash, power outage, slippage, market makers, stop hunting, right? Things can occur and they'll push other stops down and to break the market. So if you're in at $110 and they push the market down to $93 and then you have $115,000 invested and now you're down 62,000, there's nothing you can do. Once again, my first thought is, what can I do to mitigate disaster and eliminate losses out of my life? And this is my 7-step blueprint. Number 1, buy 1 share of a company. Number 2, buy 1 share of an index. Step 3, laser focus on 3 power stocks for your long-term portfolio. 2 tech, 2 index. Step 4, contribute monthly to your long-term portfolio. Number 5, swing trade for growth twice per week. Maximum. Which days should that be on? You put it in chat. I'm going to give you a code. Monday and Friday. Step 6, micro swing trades for additional income once per week. And then step 7, help 5 family members, 5 friends, 5 coworkers, and 5 people in your community execute this plan. What's the biggest lesson that you have taken away from this blueprint? It's really simple. All you have to do is then go execute it. What's the difference between VTI and VOO? You're splitting hairs at that point, but I'll be able to help you and give a full answer next week. But the percentage difference is not going to be that big, but you need to look and see what the drawdown is going to be. For a stock like Amazon, when it's breaking new highs after consolidation, does it usually keep going? Yes. Amazon slowed down for a while. Salesforce slowed down for a while. Apple did as well. And then they had tremendous breakouts, hold for the long term. But if you want to be able to know, a quick comparison tool that you can look at in 30 seconds to know if one is better than the other, you can use this tool that I'm going to walk you through right. So you can come to ETF database, ETFDB, and you can put in, let's say, VOO versus, let's see, VUG. Both Vanguard, you can hit compare, and they'll break down to you the difference. So one is a S&P 500, one is a growth. You can see the expense ratio, who they're owned by, how much is under management, the volume, etc. And these will tell you the comparisons between the two. Now we can look at performance. If we're looking at 1 week return, if we're looking at 3 years, so VUG over a 3-year period returns 97.76, 3-year return, 67% for VOO. And you can see what the dividends are, the 5-day volatility, And then over 200 days, how much less volatile they are in comparison. And I'll say this in closing. I'm just here to help. I'm just here to help. Even this little screenshot this. You do not have to like me or my perspective on the market, but you'll be hard pressed to find somebody who's better with this crystal ball. If I've helped you make money, please put yes, Ian has made me money in chat. And the great part about once you master long-term investing, you don't need likes, comments, conjecture. Everybody wants to turn everything into a podcast, right? Or a reaction take. You don't need that. Some of the stocks I've called over the last couple of years, of course, Apple, Microsoft, Tesla, VOO, VUG, VGT, VTI, Shopify, AMD, Nvidia, TECL, Pool, Moderna. Before most are talking about it, on the next one, I'll tell you the price of where I called it. Short Genius, Short Hertz. The DOGE will fall apart when it was the hottest thing on earth. Kudos to Joe for having me on the show. Deborah got into AMD since 14, Carvana, Disney at 100, Boeing at 91, MGC, Melly, XLK in April of 2020, Shopify at 363. It's now at 1493.86. Neo at $2.21 and $12. It's now at $46. Moderna, I called at $26.89, is now at $241.64. And short Nikola, which is absolute trash. Invest for the long term. You have all the answers here. Next week, I'll go over buy boxes and sell areas so you can know a range of where to buy and when to look. It'll pull back. And I want to say this in closing. Master your craft. Choose excellence. Invest for the long term. I'm going to say it again. Master your craft. Choose excellence and invest for the long term. Stop getting caught up and going back and forth and arguing. And I told you guys, a lot of people are going to try to move you into asset classes that are riskier, and then you're going to get your ass destroyed. And the time in which you could have bought some of these great companies, the flip and all the plays that you say you want, you could have got from investing in quality fucking companies, but you want to gamble because you haven't been disciplined for the last 10 years, 5 years to you. For all the he doesn't know people, if you knew, you wouldn't care what I said. Because the people that I know, shout out to my guy, like I don't want to tell his business, but he was on a few weeks ago. To the people that actually made 800, 900,000, 1.23, $2.6 million on Doge, guess what? They say the same thing as me. People stupid as hell to continue to hold Doge. They should have got out at 55, 60, and 70. Master your craft, and your opinion and my opinion and no one else's will matter. Master your craft, choose excellence, and invest for the long term, and the freedom that you want will be there. I love you guys.